Good morning, ladies and gentlemen. Let's very quickly review the price action of the past week, starting as always with the very short end of the curve in the US. As we can see by the daily price action, we had very slight backing and filling, i.e. nothing at all in the euro dollars. The front part of the curve, if anything, was a few basis points lower in yield, but absolutely no indication from this chart of what is to come. As you all know, Wednesday is going to be the big day of the Fed. The two-year note equally is only 1 basis point away from where it was last Friday, so it's in a wait and see mode. Still 109 is the big level to break on the downside in the two-year note, and the five-year note equally in terms of yield is very much where it was last Friday. The big levels to break on the upside are 125 and 129, which is the moving average, which could open the way up towards the 140, 150 yield up here. The same picture is evident in the 10-year note yield chart. Very little movement last week. We have this trend line which is capping it around the 171, 172 yield level, and we have the 200-day moving average at 180. We will need to see a pretty bearish outcome from the FOMC to get it to break these levels and head towards the 190 level, which is our next stop should the FOMC outcome be bearish. It is more likely, in our opinion, over the course of the next few days to back and fill towards the 160 area before the Fed outcome and the real move, which will be either down towards the 150 yield level, which we think is going to be very well supported, or straight up towards the 190 level. In the 30-year, this is even more pronounced. We really need to bust the 250 level. 251 is the magic level. We have 257, we have the moving average, but if we manage to take out those levels, there's very little to hold it until we get to 271, and then finally this trend line which has been going on forever, for years and years, which is around the 285 area. So over the course of the next couple of days, we would not be surprised to see it fall back down towards the 227, 230 area before it decides to make its next big move. In terms of TLT, which is actually interesting, that would actually mean a pullback towards the 137 level, maybe even slightly above, just to take out stops. But then this becomes a very important swing level at 137. If it remains above 137 after the Fed on Wednesday, we could get a real squeeze on towards the 140 area, but we think that that area would catch it for the next wave down, which we still project would touch the 132 area and match this moving average, and after that we can possibly even move down towards the level of 127, but that is very much longer term, and for the time being we're looking for a move back towards 137, 138, and risk reward there is to be short for the next wave down towards the 132 area. The European markets are actually much quieter than the US markets in fixed income. The Bund tried very hard to break upwards. It managed to fill the gap it had to the Brexit gap, which was around the 6 basis points area. It could not go any higher, as we correctly forecast, and it came crashing back down towards zero. We would absolutely not be surprised to see now a range between with 6, 7, 8 basis points to being the high, and somewhere around -6 being the low. That is a 12, 13, 14 basis point range. We still see value in bonds at 10 basis points, and with a stop above this level, which would be around 12 basis points. Certainly no higher than 15 basis points. If it gets to 15 basis points, it is in full trend higher. We see no reason for that to happen. The ECB certainly is not going to remove accommodation. The only reason why that would happen would be because US markets are leading it in that direction. So for every 2 basis points that the US market moves higher, we would expect the bonds to move up by 1 basis point. So unless the US leads it fairly dramatically, we think bonds are going to be fairly well capped around the 6, 7 basis points area, and fairly well supported below around -6, -7. Complete trading range. Bonds, we think, are going nowhere, and for very good reasons. The the possibility of a new banking crisis in Europe, and also the fact that they have this embedded Deutschmark option in them, should have them remain fairly stable for the foreseeable future. The same cannot be said for BTPs. This is a fairly bullish chart for yields. We still think that at some stage we will fill these gaps above. As you can see, we have pretty big gaps from 138 in yield up towards the 142, 144 area in yield, and then finally the last gap, which comes in at 149 in yield. These are all Brexit gaps. So that would give us a spread against bonds in the region of 135 to 150. We think around the 140, 145 area of the spread, it is time to take it off and reassess and hope for a move back down towards the 125 area. But for the time being, we can only see one way for the move in BTPs, and that is back towards ultimately the 149 level in yield. Moving on to the other asset classes. In foreign exchange, we know a lot of people are either incredibly bullish or incredibly bearish of the US dollar. We've had this chart now for weeks and weeks and weeks, and really until we break 97.17 on the upside on a multi-day basis or a weekly closing basis, we just cannot get excited by this chart. Neither on the upside nor on the downside. It's traded now for weeks right between the tram lines that we've drawn, and it's not moving out. We think it's actually the Fed's objective not to let it move out, because any move of the dollar way above 97.16 threatens this longer term downtrend line, which has been in operation all the way since the beginning of 2015. If that gives way, we are headed towards at least 103 or 105, and the consequences of that would be a real shellacking of the emerging markets, and also a quite a bit lower S&P. we think that the Fed is going to do all it possibly can to hold the US dollar around these levels. So at these levels, it's probably a good risk reward short via some sort of a put spread or whatever. However, consecutive closes, daily closes above it, or a weekly close above it, really starts changing the picture, and you have to start getting very bearish of things like gold and to a lesser extent the equity markets, especially emerging market equities. Now, what is going to make it break to the upside? Well, the only thing that could make it break is interest rate differentials. So we expect the largest move to come from the fixed income markets, and we've already talked about TLT. So the only thing that we foresee breaking, causing the DX to break on the upside is a much lower TLT. So that bears watching. We still think it's unlikely that the market can sustain closes above 97.16, but you know, we shall see. The one chart which continues to favor a short is the gold chart, and that is why we do not exclude the possibility of DX breaking higher. It has broken on Friday this trend line, which has held for several months now, and we would not be surprised, as we wrote last week, to see the gold market test this 1240 area. After all, if all the markets going back to pre-Brexit levels, the pre-Brexit level is right here, 1265. So we would really not be surprised by a cascade lower into the 1250, 1240 area in gold. But certainly it cannot stay around these levels. It either is going to break decisively the 1300 level and cascade a quick $40-50, or it's going to basically take out this level, this descending trend line that we shall put in right now. And basically then this will be some sort of a flag, a bull flag, and then we are looking towards much higher levels of, you know, in the region of 1500 most probably. So it is certainly going to be a volatile period in gold over the next few weeks. The risk reward still says the lower levels are more likely than the higher levels, but we have an open mind here because it is all tied to DX. Going back to the DX chart, certainly the Fed could cause the DX to collapse, and the 93.83 area is going to be very important. If we break that, we think we certainly go and test this area around 91 and a quarter. So it is that is a good 5% move in the DX from where we closed on Friday, and that would certainly move the gold market by at least $70 to $100 on the upside. So we are certainly at inflection points, which is not surprising given that we have the Fed coming up, and we will keep you updated on a daily basis as to what our thoughts are on these two pivotal charts, which are the DX and gold, and they are of course tied together. When one is looking at the dollar, one should always look at the Swiss franc because it tends to be a leader in terms of direction for the US dollar. It has been triangulating for the best part of a year now, or, or even longer, 18 months. It will undoubtedly break this triangle fairly soon. Just so that you have these levels in mind, you're talking about very close to par on the upside, just slightly lower, and basically you are talking about this level, the 95.40 to 95 level on the downside. Whichever way the Swiss franc trades first is the level, is the direction that the dollar index will most likely take, of course in reverse. If I'm sorry, not in reverse. If the if now we break the par level, DX is going up, gold is going down, and vice versa. We still think the objective of the Fed is not to allow it to move out of this area, but the Swiss National Bank might have other ideas. So we shall see, but certainly we think that the Swiss franc is going to be our leader, as it was on many separate different occasions for the dollar. We certainly think that this is far more likely to give us a true indication of the dollar's trend than the euro, sterling, or even the yen. As you know, it is BOJ day on Wednesday morning as well. So a quick look at the chart of Euro Yen tells us that they are exactly in the same position. Euro Yen has been triangulating here, and we are due a fairly sizable move. The Bollinger Bands are constricting, indicating that the next move could be quite sizable. It certainly would not surprise us to see the yen, either euro yen, move either towards 121, or if it breaks the triangle to the downside, it could possibly make new lows way below 110, possibly towards the 105 to 100 area. We find the implications of this, and the implication is that unless the euro is collapsing to parity, the implication is that dollar yen is way below 100, possibly 95, all the way down towards 92. If we find it hard to believe that that can be allowed to happen, because that would be such a risk-off event that we wouldn't see equities for dust on the downside. So we think that that is unlikely, and we still think the likelier path is going to be up towards the 120 area. But live and learn. We shall keep an open mind. We have no position in it. We just find this chart slightly frightening for its implications for risk assets. Moving on to equities, all the moving averages are still pointing higher. The week brought no resolution. This 2110 area with the previous highs in it in ES is still holding. The very short-term moving averages are down, but the longer-term moving averages are still pointing higher. We just cannot see, although we can see a new leg lower for whatever reason, we still think that the 2075, 2080 area is going to be very, very well supported. We find it very difficult to believe that we'll be able to close any stage below the 2050 200-day moving average. We'll be very, very surprised to see that happen. The other charts are naturally supporting that view. The strongest market by far is the Nasdaq. That is still pointing to much higher prices. We are talking way over 5,000 if we are right. The other charts, which are the the monthly charts are still holding the all-important level, which we think on a closing basis around the 21-25 area. We think that this moving average is very, very important for the monthlies. Every time it has broken it on the downside, it's gone and tested much lower levels. We're talking about 3-4% lower. So if we break this level on the downside, the 21-25 on a monthly closing basis, we would not be surprised to see it go all the way back down towards the 2000 area. So this is going to be lying in sand towards the close of the month, around the 21-25, 21-27 area, and we don't expect that to give way. The emerging markets did give up last week, the week before, recovered slightly in line with DS. This week, this is beginning to look more and more positive. So unless the market closes way below 34 over the course of the next few weeks, we expect then, after testing these levels, that the market will break considerably higher and go and test levels around the 38 level where it got to, but eventually towards year end we could see it testing levels that it hasn't seen for a long time, i.e. around the 43 level. This looks like very much an inverse head and shoulders. We would not be surprised that after a battle in this area between 36 and 34, we resolve to the upside and towards 42 to 45. We're still much less bullish about the stocks and Europe. We think 2860 is the all-important level, and now it's not very far away. It's only 75, that's 2% away. This level is going to be very, very, very important. We think we certainly hold it to the first couple of attempts, but the longer term picture is going to require a lot of work before we feel comfortable with saying that the stocks is in a similar position to the US markets or even to the emerging markets. It is still the weakest market that we see out there, far weaker than DAX. DAX, although it might go and test down towards the 10,000 level, is still on a weekly basis far better positioned, with the moving averages now turning upwards than the stocks, and that basically tells its own story about European periphery. Germany is going to continue to be stronger than European periphery, and the DAX should be favored on the upside to the stocks, and vice versa. The stocks should be sold when one is looking for a bearish position. We really cannot see much chance of the DAX trading much below 9,500 in the long term with this setup in the moving averages. Certainly the DAX is far, far, far technically better positioned than the stocks. Since we have the BOJ on Wednesday, let's have a very quick look at weekly Nikkei. This is the moving average shape. Well, it's telling us that this market has a lot of work to do before it's ready to go and bust the 18,000 level. Any rally towards 17,200, 17,300 in our opinion is a good shorting level. What is support? Well, support is around 15,200. That is the level where we would be happy to be long of Nikkei for bounces back up towards 17,000. But certainly this market is one which is not going to assume a bullish shape in a few sessions. It's going to take weeks and months for this market to start assuming a truly bullish shape. On the dailies, that can be seen with these lows around 15,950, just below 16,000, being levels where you might consider going long for squeezes, but certainly much more likely around the 15,000, 15,200, where you want to be long for further upside, because the stop loss level is very clear. Anything below 14,600, 700, you really don't want to be in this market, because you know that even if it does squeeze back up, it's going to come back down. It's going to be a mess. So unless if you really want to trade the Nikkei, it's a short-term trade, and it's basically saying that any dips below 15,900, you go long for basically selling it around the 17,000 level, or just lowest into 16,800. That is all that chart is saying, apart from the fact that this market is not ready to go anywhere unless the BOJ does something amazingly dramatic, and this chart is telling you that they're not gonna do anything amazingly dramatic. Conversely, looking at a weekly chart of the yen, it is still very much in bearish mode. There is a real possibility, since it's failed to close above the 104 area, 104.50 area for so many weeks, that we have a complete breakdown, as we indicated with the euro yen chart, towards 96 or even 94 area. These kind of levels, we think that will be the final low in the yen, and probably a very good buy for the longer term move back towards the 105 to 110 area. We are certainly going to be playing the yen if it starts trading towards the 95 level. We will definitely be buying some sort of a call spread for the upside. We think that's going to be extremely good reward and a good investment for our money. All of which gives you our biases for the week. In terms of data, we have nothing out till Wednesday, so the markets are going to be very quiet for the first couple of days, building up towards a volatility event on Wednesday. The bunds, we still like them at 10 basis points with a stop around 15, as we indicated. The BTPs, we think they are going towards the 150 area, and the break on Friday of 130 against the bund should actually accelerate the trend up in BTP yields. The ES, we like it around the 2075, 2085 area. That is where the times 16 Blue Angel comes in. For those who have followed those up for a long time, we like buying the first test of a Blue Angel line. It tends to work very well. Stop 2060-ish. We still think the market is going to have a very tough time breaking the times 17 Blue Angel, which is around the 2180 area. We definitely want to remain short above 2180. Gold, as we indicated, there is value long around, a drop of 50, 60, $70. At the moment, we still think it's a good risk reward short, unless it breaks that 1300, 1360, 1370 area, in which case it becomes a break of a bull flag with much higher levels. So actually being long of volatility right here, right now, is not a bad trade, because the market will be certainly $50 to $70 away from the current level in a week's or 2 weeks time, and that is not what volatility is pricing in. So we think volatility is probably cheap in gold, and probably a good buy. DX, well, as we indicated, value longs only after weekly close above 97.16. We actually prefer to see a couple of weekly closes. TLT value short around 137, 138 area, which was the previous breakdown area, for a move back down towards the 130 area. We do think bonds are going to get squeezed at some stage. Whether it be before the Fed or after the Fed, we don't know, but we do think it gets squeezed, and looking for stops even above 138. And as we said, the Japanese yen will watch the 95-96 area, where we intend buying long-term calls. We've thought for a very, very long time that the yen needs a complete flush, and that could be it. And after that, there could be sizable intervention, and we could re-establish a new trend, and certainly move towards the 107 and 110 area in dollar yen. But all the charts that we see in the yen, whether they be the Nikkei, whether they be the Euro yen or the Japanese yen against the dollar, indicate that it's going to be an unsettled time over the course of the next few weeks, and therefore options are probably your better bet. Of course, we'll be advising you as things change. Have a very nice weekend, and we'll speak to you on Monday. Thank you very much.